Kali Persall, editor of Institutional Investing in Infrastructure. Joining me is Albert Tan of corporate law firm Haynes Boone. He's going to talk about subscription financing, how it's being used by infrastructure players, and the outlook for this financing model on the back of the 2023 banking crises. Before we start, Albert, can you give us a brief introduction of yourself and a quick explanation of what subscription secured financing is?
My name is Albert Tan. I'm a partner and co-head of the fund finance practice group at Haynes Boone. We've been in the market since the inception of the fund finance business. So it's going well over 30 some years. Subscription secure financing or capital call financing is basically, it's a line of credit, typically in the form of a senior secured revolving credit facility, and is used to finance activities such as using for new investments, fees, expenses, basically usage that would otherwise get funded by capital contributions of the limited partners in a private capital fund. So this type of financing is unique in that it is secure not by the assets of the fund, but by the capital commitment of the fund's investors. And the financing is arranged so that there is a borrowing-based concept that is largely determined based on the value of the pledged capital commitments of the institutional investors, usually highly rated, and there is an advance rate based on the credit quality of those related investors. The purpose of the subscription financing is usually to provide short-term liquidity to the fund on a fast liquidity basis in lieu of calling capital. So under a typical subscription financing, the loan proceeds can typically be made available within a day, while a typical partnership, when you make a capital call, it could be anywhere between 10, 15 days before the capital contribution arrives to the fund. So it offers a lot of financial flexibility to a fund to have this subscription line in place. In light of the funds having the flexibility to call capital less frequently by combining multiple cash flows into a single capital call, this in effect can help manage the capital call so that when there is a bigger need for capital contribution, you can kind of bundle it all together. But I think, really the most important aspect of most private capital funds having access to subscription facility, including infrastructure fund, is the high level of financial flexibility and the ease of gaining capital on a really short notice. And most importantly, I think it also reduces administrative burden on the part of the private capital funds. So this product, the subscription financing product overall, makes up the largest component of the overall fund finance market, which it's estimated to be anywhere between 1 trillion and 1.5 trillion. So it is certainly a global product in the overall financing market in the world today.
So you explained a bit about how this financing model works, and I just love to hear how infrastructure funds are using this as part of their investment thesis.
Yeah, sure. I think, the product itself, as I mentioned, it's not the subscription financing product as a whole is really kind of agnostic to private capital sectors. The product originally was centered around real estate private equity, but it has kind of migrated to all the different asset classes, including infrastructure funds. In fact, there was a statistic from a data aggregator in the year 2000, maybe less than 10% of private capital fund use subscription financing. And now fast forward to 2024, over 90% of private capital fund uses subscription financing. So in the case of infrastructure funds, so aside from basically making investments and also use subscription financing to make investments and also to pay partnership expenses and fees and so forth, infrastructure funds, similar to, I think, real estate funds, they have needs, for example, where if they're bidding on a particular project and they need to put in some kind of a good faith bond to secure a particular bid, in lieu of calling capital for that, the investment fund can draw down or request a letter of credit to be issued under the subscription facility for the purpose of securing that particular bid. And also there's some instances where they need to bridge basically a construction project where before they could line up the permanent financing, they could utilize the subscription financing to tie it over to the permanent level. That is kind of what we see a infrastructure fund utilize a subscription financing. And in fact, we're working on several right now that are new vintages of infrastructure funds that are in the process of negotiating terms for subscription financing.
So kind of rounding this out, we're halfway through 2024. What are you seeing that transpired in the first half of the year, and what is your outlook for the rest of 2024?
It's a good question. So I think basically starting in 2024, I think our general view and most of the folks in the market is that the subscription financing is very resilient. The market is very resilient. In fact, we are seeing number of new U.S. regional banks as well as international banks who were not previously active in the fund finance market entering the market. 2023 led to a situation where the demand for subscription financing outstripped the supply. And now we're starting to see where the additional supply of financing is coming into the market. And also there are instances, development in the market where rating agencies are coming in to help provide rating to the subscription fund to open up additional liquidity for certain lenders. For them to come to the market, they need the facility to be rated. So those developments are very beneficial for the health of the market and to generate more liquidity to fill that demand. It's interesting, Kelly, is that we did at the beginning of 2024, we did a survey among the financial institutions in the fund finance market, asking them what is their in the institutional level activity expectation for 2024 and what is their market level activity expectation for 2024. And 77% responded, basically said they feel that their institutional activity is going to be slightly to significantly up. And then with respect to the overall market, 63% responded that they feel overall the market will see slight to significant increase. So those are all generally very positive sentiments. And kind of what we see kind of in a more granular breakdown in Q1, we saw a lot of refinancings, extensions, amendments to existing facilities. In terms of the new commitments for new funds raising capital, however, in the Q1 space was relatively mild compared to perhaps previous years. Talking to our clients during that Q1 period, many of them said, well, that's just kind of the timing of the fund sponsors raising their funds. But I anticipate that by the second half year, the activities for new commitments for new fund will materialize. And sure enough, I think for us, we started to see basically the second week of May where these new commitments for newly raised funds starting to materialize in light of the momentum that's been built, kind of what's in the pipeline. We're cautiously optimistic that momentum will carry us through the Q4. So hopefully 2024, by the end of it all, we're going to still see another very productive year and active market for the fund finance market.
Yeah, I think that's a great way to leave off. It certainly sounds like momentum is strong and the market's growing. So thank you so much for sharing so many good stats and insights. I know the search for liquidity is at an all-time high right now. So it seems like a really unique way that infrastructure players are achieving that. So thank you so much, Albert.
You're welcome, Kelly. Enjoyed talking with you.